For more content on today's episode, make sure you check out the Al Nicoletti YouTube channel, the Al Nicoletti Facebook personal page, the business page under Al Nicoletti, and the Al Nicoletti Show, which is on iTunes and Spotify, with all the amazing guests that have been on the Al Nicoletti Show. It started all last year. It's gone into this year. It's been an incredible year with all these amazing real estate guests, focusing in the Florida real estate market, but now kind of going outside of that a little bit, finding the real estate adjacent, finding the investors, the professionals that really know their industry in the real estate world. So stay tuned for this special episode. It's going to be a great one with the multifamily investors. They're killing it in the Jacksonville market, so stay tuned. Hey, everybody. My name's Al Nicoletti. I'm an attorney here in Florida, and welcome to the Al Nicoletti Show, where I bring on real estate super investors, rising rock stars, movers and shakers, and leaders of clubs in their community that educate, entertain, and inspire all things on Florida real estate and going a little bit beyond now on how you can take your company to the next level. On my show, I have the duo super investor multifamily guys on the show, Steven McAdoo and David Dawkins. I love these guys. I was able to connect with them on another podcast that they both have, and they're incredible at what they do. And I can't wait to bring them on. It's going to be an amazing episode talking about multifamily and how you can crush it. But before I dive into getting into them right now, I just want to say a special shout out to Nate Hare at New View Trust. Nate emailed me yesterday about a new conference that New View's doing. Make sure you check it out. We put it down in the chyrons below. It's going to be really cool. A big investor thing happening in Orlando, January 6th and 7th. I mean, they are supposed to have like 400 people show up at that investor conference. It's going to be incredible. So make sure you check it out. I think they even have they're going to put out more flyers for everybody to see. So Nate, New View was even on the Al Nicoletti Show. I have the dollar sign that you can see here, and then the house. Incredible guest Nate was. You could go check him out on the show. He had his episode. It was great. So shout out to Nate. Thank you again. Amazing conference that's coming up. So make sure you check it out. But again, today's episode, we're going to crush multifamily. We have David Dawkins and Steven McAdoo from Seven Bridges Realty Group. You can connect with them. They're all over social media. They have their podcast, which is incredible. And you know, they're really doing what they do in the multifamily market. And we're going to dive in on this stuff today. So what we're going to talk about is why the small to medium-sized multifamily niche is such a great asset class to build wealth with. Why are people going more to multifamily? I even see that with investors that are doing it more and more, stepping outside of family and residential, going more into multifamily. So these guys are the masters at it. And why Jacksonville is a great market to invest in, and why it's so important to build relationships with brokers in your market. Building relationships and networking with the right people is so important. They're going to tell you why it's important with multifamily. And as a special little hot topic that I know they want to talk about is about the Fed tapering bonds and how it affects interest rates and how it affects the markets going forward. So I can't wait to dive in. Let's welcome them to the show without further ado. David, Steven, welcome, guys. I'm so excited. Let's dive in on this stuff.
Yeah, absolutely. Thanks for having us, Al.
Yeah. I see Steven's on the go. I love that he's in the car, going and going. And David, I love being on the podcast with both of you. I thought it was a blast. And I think you could provide such a great value to the audience that's watching the Al Nicoletti Show. So Tell everybody, how did you even get into multifamily and where are you today?
If you want, I can go ahead and go first. And basically, honestly, I got into multifamily and just real estate from initially. I'll just make a quick story, but basically started getting into just personal investing, navigated to real estate, got into single family initially, and then got my broker or my agent's license and my broker's license. And long story short, just kind of navigated, and I've been focused on multifamily for the last really 2 to 3 years now. So just kind of traditional path, I would say, just like most people, you start going into investing, get into real estate, and then just work up to larger assets.
Sure. And my path was, I started my real estate journey with a developer actually when I was in Chicago. That's kind of where I learned about the business. And when I moved back to Jacksonville a couple of years ago, which is where I'm originally from, I decided to jump into brokerage and specialize in the multifamily space, and specifically kind of small to mid-sized properties to carve out a niche there. So that's kind of there's a longer story, but basically that's kind of how I got into it. And so I've been, working in the space for the last couple of years.
Love it. Love it. So tell us, why is the small to medium sized multifamily niche such a great asset class?
Well, I can, and I'll try to, there's obviously a lot of points, but I'll just try to kind of run through them real quickly. And then, Stephen, of course, you can add to it. But I mean, really, and some of these, to start out with, just kind of cover your general, benefits of buy and hold, rental real estate. So obviously you have your cash flow, you have your income, and when you compare that to, we always talk about comparing to alternatives. And so if you compare that to, even though cash on cash, you're not getting what you were a few years ago, when you compare that to, say, the dividend of a stock, it's still very favorable. The tax benefits you don't get, the depreciation specifically, obviously it's a paper loss that really helps you from a tax advantage, standpoint. And really the great thing with multifamily too, you can utilize cost segregation studies, which, I could expand on that, or we could, if someone wanted to reach out, I could talk to them more about it. But basically it's going to accelerate that depreciation and then maximize that tax advantage. And then naturally you get, the equity pay down, you're gaining equity as the mortgage gets paid down. You have your appreciation, your market appreciation, which in multifamily, it's more cap rate compression, is kind of similar. And then, the huge, big thing with real estate, obviously, is, you can leverage it. So, you're basically, that's what I love when you see, stock markets up 20, whatever percent, real estate's up percent. The difference is, with stocks, you gain 25%. In real estate, you just doubled your money because you were only in it for 25%, typically on a typical, investment property. So that leverage is huge. With that, you're sharing risk with a lender too. Another institution, another party is underwriting this deal and is signing off on it as well. And then a big thing, which is, I think, really important in today's market, is the hedge against inflation. So that's great for just general real estate. Most people know this, but it's a great hedge against inflation. And really, when you're carrying the low interest debt that you're getting today, it's really performing even better because, inflation currently is higher than the interest rates you're paying. So not only are you hedged, you're actually benefiting over the course of that loan. So those are, some great general points. And then specifically, we get into multifamily. The great thing is, once you get to 5 units, it's a commercial property. So you're basically buying a business. It's valued as a business. And so that you have more control over the valuation because, they're going to take that income approach versus the comp approach. And so while you're still, again, market cap rates will come into play, but as far as your NOI, you have a lot more levers that you can pull as far as, increasing income, lowering expenses to generate a higher NOI, which then will relate to, a higher value of the property. So that's the big thing when you get is that control over the valuation. The financing's still great. Once you get over $1 million, it's very easy to get 30-year amortization loans, low interest rates. Sometimes you can get into, well, now especially, for the property. Obviously, when you start to get larger, there's the economies of scale, which I think is huge too. With your expenses and CapEx are much easier to project and they smooth out over time, as opposed to, say, a single family. Everyone's using percentages when they're underwriting, but we all know you just get hit one expense one month and nothing for the next few. So it's a little more consistent. And then I think our niche too, what we always say, under that 100 units, you're really not competing with your larger institutional. And Steven can speak to this, they're starting to come down just as there's just more demand for multifamily, but you're kind of in a good sweet spot to where you're getting all the benefits of commercial, but you're not competing against, as larger players as you would be if you start going to 100 plus. And then, a big thing, which I think is also a benefit for this size, is the time frame of the projects. Most people, when they're, let's say, a typical value add property, you have your business plan that you're gonna, forecast you're gonna go in and turn so many units into your renovations. But when you have a smaller property, you're able to get that done in a shorter time, which obviously the further out your time horizon is, there's more risk involved. I mean, no one can predict 5 years out. So having the ability to do your project and your terms, quicker is it just lowers your risk. And so I think those, overall, I mean, those are some of the big things, because even on the last one, like technically they're all 12-month leases. So if you had a 400-unit building, you in theory could do it all in a year or two, or a couple of years, but you would have so much vacancy. You would need so much extra money to begin for that to work. And so that's why when it's, say 50 units, it's a little more manageable and that's where it's more manageable too. We talk about, people getting into multifamily. It's easier to progress up, to a 50 unit than obviously those larger ones. So in a nutshell, that's kind of, obviously I just rattled off a lot. So, Steven, you can kind of add to it. And then Al, if you got any questions, but in a nutshell, those are the main, benefits of this niche.
I felt like that was like multiple nutshells. Like there's just so much to unpack in what you just said. Like there's so much. Steven, what's your take?
Yeah, David touched on a lot of great points. Why the niche that we play in is attractive, because it's not as heavily scoured by as many big institutional investors with lower cost. You're not competing with these big groups with whose cost of capital is much lower than yours. So I think that it allows people to have a little bit of advantage, especially if they're local to the market. You're not going to have some of these bigger groups going after a 24 unit deal. It just the size just doesn't make sense for somebody on the West Coast or in the Northeast. But you may be here locally and feel like you have a competitive advantage in that regard. So, and it's just a great next step for somebody who's maybe already done single family and some other things, because it's not so this daunting as going and doing a 200 and 250 unit deal. But I think that the financing, like David touched on, is super attractive. It's a nice stable asset class. It's not nearly as you could go into commercial deals like industrial or retail or other things like that, but obviously an industrial building is the leases are chunkier. You have a tenant, you lose a tenant, and then it's maybe vacant, maybe it's for a year and a half, 2 years or something like that, whereas multifamily is very generally much more stable. Cash flows are pretty predictable, and the financing is just super attractive, especially right now. So it really just checks a lot of those boxes, and specifically we'll touch on here in Jacksonville why it's great, because we're all fortunate to be here, because Jacksonville is just such an excellent market to be in, especially right now, where we're seeing things, and we'll touch on that as well.
Yeah, I don't know if it's just been recently, or I've seen a couple investors post like their stories. Like Jesse Lane posted a video the other day on Yellowbird and some of the on his page about buying a multifamily unit. I would think it was like 12 units, and just generating a lot of cash flow, and crazy cool stuff with investing with multifamily. I mean, it's just amazing what you could do with it. But let me ask you this: what is it? And this may go a couple ways. Like, what is it like qualifying for loans with multifamily? Is it hard? Does it depend on like the value or the asset class? And like, what's the most ideal multifamily situation? Is it that generates cash flow? Is it 4 units? Is it 12 units? Is it 50 units? Is it 20 units? Like, or does it depend on like cap rate or the amount? Like, I don't know this world. Like, you two see it every day. What's the most ideal situation, and what is it like qualifying for that loan?
Well, that's actually a really good question, because depending on the size of multifamily deal you're doing, the financing changes a lot. When you're doing smaller deals, if you're buying, quads, then you're getting a standard conventional 30-year fixed rate mortgage, most likely, if it's in good condition, like you would, just applying for a single family home. So that financing is relatively easy to qualify for if you have, like a W-2 job. an income that a typical conventional lender would lend on. And that debt's also great because it's 30-year fixed rate, locked in, no prepayment penalties. So a lot of people, I mean, I don't think there's anything wrong with the strategy of just trying to accumulate a lot of, quads all over Jacksonville, because that debt's so attractive. And then at the other end, when you go $1 million in loan size or higher, and the property is stabilized, you're typically looking for like an agency loan done by Freddie Mac or Fannie Mae. And that debt's going to be great because it's also 30-year amortization. It's non-recourse. It's the rates are usually very low. The property has to qualify and meet certain metrics. They have things like 90% occupancy for 90 days and other things that it has to meet to be able to get that type of debt. But that's really, really attractive debt as well. And then you have this kind of we call them like these donut hole deals where the property is maybe like an 8 units, maybe it's, let's say it's $800,000. And, you can't obviously get a normal, typical, conventional mortgage on that because it's over, it's 5 units or plus, but it's too small to get agency debt on. So typically there you're going to local or regional banks, which also there's some local banks here that have some really great terms on those deals. So really I would just say that it's really going to be a function of the debt being, what size the property is, what condition it's in, and the experience of the borrower. But any of those properties depending on the size, can get some really attractive, debt on it. It just depends on what is the appropriate, type of financing for the situation. But I think that any of those can be really great. Like I said, I mean, a quad, you could get a 30-year fixed rate loan, maybe a rate. I don't know what they are, right at the moment, but you don't have to worry about like a balloon payment like you would on a normal commercial financing deal. Typically a commercial loan, you're having some sort of balloon payment. Even if the amortization period is 20, 25 or 30 years, you're paying that note off in 5 or 7 years or something like that. But you buy a quad and so anyway, they all have their advantages and disadvantages. But that's kind of an overview of the the financing setup for all those different types of properties.
I'll have to make sure if I ever do in person, when I do in person, I feel like if we sit down together, we're going to have like a 3-hour podcast because there's just so much to unpack with this thing. Like it could be like a Joe Rogan style. Like
I know we could.
Yeah. Break it down, go through the whole thing. It's not enough for 40 minutes, an hour. It's just not enough. And I love the content because Steve, what is attractive debt? Like I've heard of good debt and bad debt, but what's attractive debt? And with multifamily, how does that affect like the taxes, like the tax brackets for you all, or like how does that affect that everything?
Well, I say financing and the tax bracket and things like that are sort of independent of each other. I guess I'll say what I would consider attractive debt first. So basically, if you're looking at any deal, obviously you're trying to get the best terms possible in terms of lower rates and everything. But I would say that typically when you're looking at any sort of debt, other than just simply the rate, what are the fees? What's the amortization period? What's the prepayment penalty look like? Is it recourse or non-recourse? Which means, if the property ever, goes into default, can they come after you personally, or is it just, do they just have the ability to take the property back? So all those things, and like we could probably put a chart together of all the different types of financing and say, what's the benefit of this versus the disadvantage of this and all but basically all those characteristics are things that, you're looking at when you're evaluating any sort of, financing option to see if it's, attractive or not. So it really just depends on the circumstance. There's no, you can have a good deal, but if you put the wrong type of debt on it, you can turn a good thing into a bad thing. So the debt has to match the property and the business plan. I would say is really what I would say makes certain financing attractive versus not. And then the second part of your question was, I think taxes. And I think David can touch on cost segregation. He knows a lot about it and why, if you qualify for the real estate professional tax status, and you can use all of the, the losses that maybe somebody who's like a W-2 employee that is limited in the passive losses they can use, can be really attractive. But I'll let David talk a little bit about cost segregation and how that can benefit people and what makes it so attractive from people who do qualify for that.
Love it,
Sure,
Steven.
sure.
David, go for it.
Yeah, I'll expand on that a little. And basically, obviously, everyone's tax, it's your personal tax. I mean, it's going to flow down to your personal tax return. So everybody is different. But basically, there's the advantages, the major tax advantage of real estate in general is the depreciation that you can claim, because it's a paper loss. And we all know, as a whole, real estate generally, appreciates over time. So you're actually getting to write down the value of the asset for tax purposes, when in reality, it's gaining value. And then, and the big thing about with, multifamilies, you can do these cost segregation studies that essentially accelerate the depreciation. So normally you would just take the value of the building. You can't depreciate land, but the building, and you would divide that over 27 and a half years. But you're actually able to break down components of the building and depreciate it faster. So basically you get a really large paper law. You're just speeding up. You're taking, instead of having it consistent over straight line over 27 and a half years, you're getting the bulk of that up front. And so the great thing is that's always going to offset your, any cash flow you get from the property. And then two, what Stephen was touching on as well, I mean, depending on your personal tax situation, if you're considered a real estate professional or not, it may be able to offset other income you have too. So even if you're not, say, if you're a real estate professional, that it's all treated the same. So you're able to offset, say, active income. So if you're say you're a house flipper and you make a bunch of money flipping houses, and then you go invest in a multifamily, you can cost seg that, and that depreciation will offset the gains that you had from flipping homes. And so, and then even if you're not a real estate professional, depending on your other passive investments, it may be able to offset gains there as well. So it really varies by person, but there are some major, tax advantages that will at minimum offset any gains you're getting from that property, and possibly others.
Yeah, I think that's where I was kind of heading, was like, you can get some really good tax benefits going into multifamily versus going into residential land or commercial, doing all those other things, because of so much cash flow and depreciation and everything like that. So
yeah, absolutely.
Great. That's great. So let me ask you this. And it was something I asked backstage if we could talk about, which was buying, like, what is the difference and what are your thoughts on buying multifamily for rental use versus short-term rentals? I've heard a lot of people talk about using multifamily to generate like 3 to 4 times the amount of cash flow, using it for short-term and not having to deal with tenants, all the issues with long-term leases. There's just more money. So what's that about?
I would say on that too, first off, anyone thinking about that just needs to understand that it is two different business models. You are going from running long-term rentals to essentially you're running a hotel. So like you just said, it's like, no, you're not dealing with long-term tenant issues, but you're dealing with, hotel guest issues. I'm out of toilet paper, I'm out of soap, or whatever the case may be. So you have to realize that it is a different model. And then again, it's kind of like everybody, it's like, what are your individual goals? Are you going to be involved, or are you going to, have another company do this for you? And there's plenty out there that will, but they're going to charge, more than the typical, management company, because it's obviously much more, labor intensive. So just understand that it's two different business models. But to your point, you can, if you execute properly, you can certainly generate, much more cash flow doing short-term rentals than you could otherwise. The one caveat I would just say, probably the biggest thing, because this actually just came up, yesterday, a friend of mine was like looking at a property in Tampa and said, hey, what do you think about it? And he told me the income, and right away I knew, because it was so high, that I was like, that income is based on short-term rentals. And he said, and he was like, yes, it is. And then so I just told him, and on paper it looked like that it was a decent deal, but he only, at the price that they wanted to sell it for, he was only going to be able to run it that way. He would not be able to switch it to long-term rentals, and it makes sense anymore. So he was locked into that strategy. But two, the biggest thing that I told him, and this is probably the biggest factor between the two, is the financing of it. So a lender isn't going to underwrite it with that short-term rental income. So even though it may justify, in this case, it was a duplex that they were trying to sell for $1 million. It basically, they were not going to, I just told them, I was like, you're not going to be able to get a loan. It's not going to appraise for that amount, and two, duplexes back to comps, which like we talked about earlier, but let's just say it's a 10 unit and you're going off the income approach. The lender isn't going to use the higher income from short-term rentals. And so that's where, essentially when you're buying it, you need to know that if you're looking at a deal, because you may not be able to get, 75% LTV because they're not going to look at it the same. And then the other thing I would just add to that is the biggest thing, what I was telling, it's like on the resale side of it, all your buyers are going to run into the same issue. So your pool of buyers is going to shrink because if you're trying to justify a really high amount based on the short-term rental income, then they're going to essentially you're looking for almost a cash buyer or someone who's going to pay with a heavy down payment. And so that's where, the way I kind of advise people when they're considering this is, does the deal, will it still work as long-term rentals? Do you have the option to switch it all? And maybe you don't make as much income, but you can still sustain, a downturn. If you have to hold the property, you can run it that way. And say COVID happens again, Airbnb gets shut down, et cetera. So just protect your downside that you can still operate it. And same thing, don't count that when you're like, oh, my value went up, 5-fold. It's like, well, like yes and no, like basically enjoy the extra cash flow you're getting if you choose to run it that way. But then in turn, when you go to sell it, you're going to then have those issues again. So, and what you commonly see, I think, is you see people utilizing a portion of them. And maybe I say that commonly, it depends on the size of property. If you have a 6-unit, then sure, you could just Airbnb all 6, run it like a little true bed and breakfast, and you could do great. But you're going to have, again, problems, turning to sell it. So what you see a lot of times with larger complexes, they may carve out, 10% of the units, right? So say you have a 50 unit and they just depending on the property, they Airbnb, 5 of them. You see, situations like that where people try to, get a little extra income, but it's still as a whole, it's ran, more traditional. So Steve, you can, add
no, those
Great
things,
stuff.
patient and financing are I think that a lot of sellers will do this. I've seen where they'll basically be operating something as a short-term rental, but they'll apply a market cap rate that would be applicable to a standard conventional, long-term rental building. And that's just not, and some buyers may do that and be duped by that, but that's not how it works. You wouldn't have the same cap rate for a 150 unit multifamily building that you would have for a 150 room hotel because of the variable nature of the cash flows. So the valuation's different, the financing is different. Like David said, there's financing options, but there's not going to be necessarily, not going to be as many, and they're not going to be nearly as attractive as you would get on a typical conventional stabilized. So I think that, it probably sounds here like we're bashing short-term rentals, and we're certainly not, because there's a lot of money to be made in short-term rentals, and people out there well with them. It's just a completely different business model. The financing is different. The operations are different. Valuations, everything is. It's people, I think, sort of group those two things together, but they're just very different businesses. One is very much more passive nature, and one you're running a business. You're really running a very active in nature business, and so they're just very different in that regard.
I love that you both see this on a daily basis, so you know what kind of model works and what may not work, and what you're looking for qualifying for loans and the whole package, right? Like you're in this multifamily niche, so a lot of investors, when they first start out, they're in residential or land, and all of a sudden they want to move to a new asset class, and they want to get into multifamily, and it's just a totally different animal, a lot of things to look for. And that's why you got to build those relationships with those lenders, brokers. We're going to talk about that. I just want to say, anybody out there that has a question for David or Steven, we're live, ask away. We're here. We'll answer it live. Just drop it in. I'll ask them the questions and they'll answer. And I just want to say, Trish, thank you so much for listening. I'm so glad you're on here watching Steven and David. It's a great episode. So guys, tell us why, and that's getting into the relationships. Why is it so important to build relationships with brokers in your market?
I'll take this one. I think that it's just brokers in Bo Beery. He's a well-known broker in Gainesville, and he puts out a lot of content, and he talks about this a lot. But if he sort of tracks transactions, and he looks back at how many are done off market versus on market through brokers, and it's still well over 90% of transactions in the multifamily space have a broker involved. So I feel like if you're going to be a serious investor and you're really out there and you really want to see deal flow and you really are set on getting involved in the multifamily space, you would be doing yourself a disservice by not making those connections with brokers, staying in touch, being very specific about what you're looking for. And I would say, if make yourself stand out, sell yourself to a broker and tell them what you're looking for, why you should work with me. I think that just by being there, meeting them face to face, and basically, going a little bit beyond, we get calls, literally on a daily basis that somebody that's like, hey, I'm looking for multifamily in Jacksonville. Send me any off market deals you have. I mean, we get that call so frequently, but that's not, it's like, well, who are you? What have you done? What specifically you're looking for? What kind of deal will work? And a lot of times we just hear, well, just send us everything. And so that I feel like doesn't ever get people very far, where the people who are really doing deals are the ones who are meeting with brokers, letting them know, hey, this is who I am. This is what my experience is. This is what my track record is. These are the kinds of deals that I want to do. Would you mind if I check in with you? Would you put me for one on your distribution list? And would you mind if I check in with you every month or two, just to, kind of see where the market's at, what's happening, maybe if there's anything new? That sort of relationship and building that over time that person's much more likely to start getting some deals coming to them and ultimately doing deals, versus somebody who's just saying, hey, send me over something when you have something, and they leave it at that. They don't ever work on building that relationship, because that's where so many deals come from, I think, in this business. And so I think that's really the importance of kind of building relationships with brokers, and not just one. Find out who is selling the types of deals that you want to buy, and go to them and say, hey, I just saw this trade. Can you tell me a little bit about this transaction? And you learn a little bit about it. You learn a little bit about the person, and you start to build that relationship. And that's really how you get involved in the business, really just getting and starting to form those relationships. But I think that's why it's so important.
Absolutely. David, your thoughts?
Yeah, I would just, 100% agree with that. And kind of, just a couple of things to add is that, when you're reaching out for the first time, do your research, first and beforehand, because it really comes through a lot. When you can tell when someone has it, when they call, for example, and say, hey, and when we ask, like, okay, well, what are you looking for? A 10 cap. Like, well, anybody who knows anything about Jacksonville real estate knows that 10 caps aren't available. So right away, I know that you don't know much about what you're calling on, so, and you haven't taken any time to research the market that you're telling me you want to invest in. So, do a little research beforehand. And then too, like he touched, if you're local, like definitely, try to meet in person. That always helps, obviously. And then you kind of have that advantage, because everybody, you'd prefer, when we get calls like he touched on, from a lot of investors, it's continuing to increase from across the country, specifically, New York and California. You have all this New York, California money. They're looking to get it out of those states, bring it to Florida. And so, but if you're local and, then you're probably going to be easier, to work with. You're going to know the local landscape. So you do have that advantage. But in general, I would say, take kind of I'm going to say sales approach, but the long-term sales approach. So, it's just the classic, like, introduce yourself, gain credibility, and then just stay in touch, and then stay on top of mind, because there's obviously in this market, that it's funny. People, I think when you get in, you're the buyer technically, but at the end of the day, like in this market, you're selling, like you're trying to sell yourself, because there's only so many of these deals, the sellers, they got the gold, like you're the one, who wants that. So you're trying to sell the broker that, hey, when we get a deal, like, who are we going to reach out to? Like, who are we calling? Are you on our short list or not? And so that's just, but staying in touch, staying, relevant, in this, that those are the ways that you're going to stay, on that short list and make sure the deals do, get to you, when they come up.
Yeah, I had a guest last week, Brad Blazer. He was talking about how, like, there's going to be people that'll come to him for, like, raising capital and stuff. And it's not just in that initial moment about like, hey, what do you have? What's going on today? It's like, build that relationship over time, right? Show up one time, 2 times, 3 times, 4 times, and like really get to know the people that you're working with. Right. And that's like what Steven was saying, and what you're saying, David. It's like, build those relationships in that community. And actually, it's why Jacksonville is so great with the real estate community, because everybody's building those relationships with each other. You're in Jacksonville. I'm in Jacksonville. We have a huge community of real estate investors and professionals here that have meetings and stuff and real estate meetups. So also tell us, like, why is it such a great market to invest in Jacksonville?
Yeah, I would say so. There's a number of things, this, again, I'll try to wrap it into one nutshell here, but basically, we have it, and everyone, a lot of people, if you're in real estate, you know this, but the general, the population growth, job growth, wage growth, we are all above the national average. And that's the case. It's not just Jacksonville, but for Florida and a lot of the Sun Belt, some of these other markets are experiencing the same thing, but we're far above the national average there. And that's driving, rental demand, because there's just a simple supply demand imbalance. And so it's driving rental demand, which is then driving rent growth, which is increasing valuations. So you have all those just general fundamentals at play. And then one thing that, we talk a lot about is, one, like I just said, of specific to Jacksonville, like Florida's getting all those benefits too. But of the 4 major metros, we're, the most affordable, by a good little clip too still. So, that we have a much longer runway, I think, than, say, other cities. And that's why you're seeing so much capital come from other parts of the country to Jacksonville. And I think the biggest thing, which this was so evident over COVID, which I think kind of also cemented in the investor community, minds, is that, we have a very diverse economy for a city our size. And so what that does is that lowers risk significantly. So when you're looking at risk adjusted returns, Jacksonville is going to come across more favorable, as in comparison to, Orlando, that is a lot of those same benefits. A lot of the metrics are on the rise, but at the same time, they're very reliant on tourism. So if something happens, i.e. COVID, like they get shut down, where Jacksonville, our 5, major industries, are finance, logistics, and then you have healthcare, military, and education. And those last 3 are traditionally very recession resistant. And so when we have, that's why you saw our unemployment rate, for example, throughout all of COVID. Well, Florida was above the national average, but Jacksonville was above the Florida average. So that, we fared much better. So, that's kind of, to sum it up, basically we have to get those risk adjusted returns, we have all the upside, but then we do have, I think, very much, protection of the downside. Like you have less risk here than you would in other markets.
I love it. Any thoughts, Steven?
No. David touched on, I completely agree. I mean, it's Jacksonville is a great place to invest. And most investors typically have, they're looking for markets that have certain characteristics, obviously population growth, job growth, diversity of industry and so forth. We're obviously very landlord friendly compared to, I came back from Chicago, which, probably in comparison to our, I would say the landlord environment here in Jacksonville. And it's incredible. I think that's why, that's the thing is, in the Northeast and probably some other areas of the country, when they, keep tightening the wrench on some of these, landlords and how they, deem it, they should be able to operate their properties. We look better and better and better in comparison when, it's funny when you're talking to an investor from another area like that, and they're like, well, what happens when the lease ends? I can just, put the market up for rent at whatever I want. But they really ask questions like that sometimes if they're not familiar, where like, because they have so many little things that they have to do and probably the market where they're at that they've just become accustomed to maybe after 20 years of investing. And so then when they can come here and just literally operate their property very freely, and kind of, as a property ownership was, really meant to be done, then that's very favorable and attractive to a lot of these investors from other markets as well. So it's not only just all the metrics, there's also a lot of qualitative factors that make, Jacksonville really, a nice place to invest. I mean, that's another thing too. You can invest in, somewhere in the middle of nowhere in the Midwest and maybe get higher cap rates. But, Jacksonville, nice thing about here too, is if you start buying a portfolio here, you have some guy from, I don't know, maybe he's in Michigan or something like that. He's actually looking forward to coming here to check on his properties because he's going to stay at the beach and he's going to have a good time, and it's going to be enjoyable, and he can, have a place where his investments are lucrative, but it's also a nice place to actually keep tabs on them. So I think there's a lot of things here that are just so attractive from an out of market investor to want to get involved in this market.
You both are so right, because I was just at a real estate boot camp, and one of the speakers got up and did a full presentation on how to find that right market to invest in. And there were just so many factors. I mean, it went from airport to NFL team to being on the beach to being in a big city with a certain population percentage. And it was just, there were so many factors, like the weather, everything. And I think Jacksonville, obviously it was top 5. It was on that list because it's close to the other states. It's easy to travel. You have transportation. There's fishing. You have the river. You can go to Orlando quickly. You can go somewhere. You can go to Atlanta, not that too far away, but like you said, that's why Jacksonville's amazing. You have so many factors here that line up, that check all the boxes, which make it great. So love it. Yeah. Amazing real estate community in Jacksonville, and amazing for investing. And take it from David and Steven that are doing multifamily and crushing it in that niche, that say Jacksonville is that right market. Guys, before I know you got to go, before you hop off, I think what's really important is, this is a kind of a new thing I've done on the show, is talking about relevant things that are happening today that are hot topics. And like we were talking about, one of the hot topics is the Fed tapering bond purchases, which affects interest rates, which affect the market going forward. What's going on? What do you know? What can you tell us? What's happening?
Yeah, and kind of it's, we've obviously touched a lot on financing, of this, because that's when you get, these are obviously majority of all these multifamily properties are financed. So the financing, the debt drives, and that's something, a lot of times people in real estate, depending on their approach, they may not even quite realize kind of why the wind's at their back. The good thing in Jacksonville is we have all these true market fundamentals, but at the same time, for the real estate industry as a whole, the federal government, the Federal Reserve specifically, they've been holding interest rates down and pumping liquidity specifically into the mortgage, industry. And so what that does is essentially it's easier to get, back to that, good debt, that low interest, longer term, it's easier to get that debt. And so basically, one thing everyone's been looking at is, well, the downside of that, when you do that, is you create inflation, which when the government's essentially, quote unquote, printing money, we start to see inflation. So there's negative effects to this. And so that's the concern is, okay, well, inflation's getting high. When are they going to, tighten their monetary policy and kind of reverse course a little bit? And so that's been the topic of conversation, because that's the one thing. I mean, here, like I said, there's the supply demand imbalance, but if something were to negatively affect, Jacksonville real estate, it would just be, if you shoot interest rates up 2%, well, naturally everything becomes less affordable and values drop. So that's the concern. It's okay, well, what's going to happen? When are they going to do this? And to get to the relevant, there was the Fed, meeting this week, and the chairman, Jerome Powell, spoke yesterday. And essentially he said they were going to start tapering their bond purchases, which are at 120 billion this month, but long, to kind of sum it up, it basically, they're going to do it at such a slow pace, and they weren't going to touch interest rates anytime soon. And he definitely said they're not going to do that. I mean, I think sticking to more their original timeline of 2023 or maybe the very end of 2022, but it's basically they're going to taper, or which when I say that, like tighten, very slowly. And he very much kept repeating that they're willing to adapt, so i.e. if they start seeing the economy not doing so well, they're going to stop that, and they could even possibly increase the bond purchases again. So it was kind of one of those things, me and Steven talk about all the time. Like, love for it to just be a true, free market and let it play. But at the end of the day, everybody's always just trying to guess, well, what's the Federal Reserve going to do? And kind of from that meeting yesterday, they're not really changing much. It's a long story short is we don't need to expect any of this, higher interest anytime soon. Now, it's something to just be mindful of and watch, going forward. But in the short term, I don't see it affecting anything, really over the next, say 6 months or so.
Crazy. A lot of things moving on and going on in the real estate market. And, the Fed and the interest rates could change the way the market shifts. And right now the rates are still low, and who knows, they can go higher, they can go back low. Who knows what's going to happen? But hey, guys, this was amazing. I loved having both of you on. I love being on your podcast. Now you're on my show. I loved it. I'm going to make sure we show the Chirons again. Make sure you connect with Steven and David. They're on Facebook, and you can learn more about them at their website, sevenbridgesrealtygroup.com. And they have their podcast. What's the podcast called?
Yeah, it's the Jacksonville Multifamily Podcast.
Jacksonville Multifamily Podcast. I mean, amazing guests they've had on their podcast, and they continue to release episodes. So make sure you check it out. Hit the subscribe on their podcast so you get all the episodes that come out when they drop them. Guys, this was a blast. Final words, final thoughts, Steven?
Thanks, Al. I appreciate having us on our show and on your show, and we'd love to have you back. And this is a lot of fun. This is great. We could sit here for hours. So we'll do it again next time.
We'll do the 3-hour one soon, so we'll make sure that happens. David?
Right. Yeah, absolutely. No, I enjoyed it. Thanks again, Al. Certainly appreciate you having us on. And then, if anybody wants to reach out to us, go to our website. You can, email us directly. That's probably the best way to get a hold of me. So, but yeah, absolutely. We look forward to hearing from anybody.
What's the email so they can get a hold of you?
Yeah. You can email me directly. It's david@sevenbridgesre.com. And Steven's is the same, obviously, Steven at. So you can just email us directly, and be happy to answer any questions and help out anybody listening.
I'll make sure this gets shared on all the groups and all the pages, my business page, profile. So people will watch, people will listen, and it'll drop on Spotify and iTunes. So I hope everybody takes a lot of value from this. And thank you both so much for coming on the show. And I know you got a lot of things to do. So thanks again, guys.
Thank you, Al.
Thank you, Al. Appreciate it.
We'll see you soon. All right, everybody. That was a great episode on multifamily. I mean, if you're trying to get in that niche, these guys are the people to talk to when it comes to that. They're talking all about the market and qualifying for loans and generating cash flow and how to do it the right way and which business models, whether it's short-term rentals or regular rentals, like what's the best business model, and talking about how to find the right market to be in and why Jacksonville's so great. Tons and tons of information that were on this episode. I took a ton of value from this. I hope you did too. You can find all the amazing guests that have been on the Al Nicoletti Show on iTunes and Spotify, the YouTube channel. You can find all the micro content that drops on Instagram and Facebook. We'll drop all the stuff on the bottom there so you can find it. So make sure you check out all the content, and I will see you next week on the Al Nicoletti Show. Have a great day, everybody.